afternoon, everyone. Hope you are finding this webinar insightful. So far we have looked at different actuarial assumptions and their relevance while performing actuarial valuations. Now let's understand how to calculate these assumptions one by one. So first here we will talk through the step-by-step process of calculating the salary growth rate, which is a crucial metric for understanding employee compensation trends in an organization. Let's break it down into 4 structured steps to ensure clarity and practical application. Now, the first step here is to retrieve the previous year's salary for each employee. If an employee is new and does not have a prior salary in the system, we treat their previous salary as nil or zero. To efficiently fetch salary details, we recommend using the VLOOKUP function in Excel, which allows us to match employees with their respective salaries from the prior year's database. Now, this ensures that we have a comprehensive data set before moving to the next step. Now, next step here is, now we have both the current salaries as well as the previous salaries. We calculate the employee increment rate using the following formula, which is mentioned as current salary divided by previous salary minus 1. Now, this formula essentially measures the percentage increase in an employee salary from the previous year. If the previous salary was 0 in case of a new employee, this calculation would need special handling to avoid errors in computation. Moving on to the step 3, we need to compute the weighted sum of increments to ensure that salary growth rate is assessed in proportion to their salaries. Now, we achieve this by using the sum product function, which multiplies each employee's increment rate by their previous salary and then sums up these values. The formula for the sum product looks like this. Sum product, employee increment rate, and the previous salary. Now, why do we use a weighted sum? Because not all employees earn the same amount. If we calculate an average without considering the salary weights, we might misrepresent the overall salary growth rate of the organization. Moving on to step 4, this is the final step to compute the average increment rate for the entire organization. We do this by dividing the weighted sum of increments that we have arrived from the previous step by the total previous salary of common employees. Common employees means those employees who were employed in both the periods. Now, the average increment rate formula is mentioned here, which is the sum product of employee increment rate and the previous salary divided by the sum of the previous salary. This is the final value that represents the overall salary growth rate of the company, which is really helpful for the HR and the finance team while making the compensation structure and the benchmarking. Moving on to the next slide. Calculation of the attrition rate. Now, here we will break down how the attrition rate is calculated, which is again a very crucial metric that helps organizations measure workforce stability and retention. Now, here the first step is to identify employees who have exited during the given period. We can do this efficiently using the VLOOKUP function in Excel, where we match each employee using their unique employee code against the current employee data. If an employee is not found in the current data set, VLOOKUP will return NA, indicating that the employee is no longer with the company. Now, this will form the basis of counting the number of employees who have left. Now that we have identified missing employees, we move on to step 2, wherein we count the occurrences of NA, which is not applicable. This count represents the total number of employees who have left the organization during the year. By automating this count in Excel, we can ensure quick and accurate attrition tracking across different time periods. Now, coming to step 3, once we have the total number of exited employees, we can calculate the attrition rate using the different formulas based on headcount considerations. You can see here we have 3 formulas mentioned. The first formula is based on the opening headcount. Now, this formula gives you a straightforward attrition percentage based on the opening workforce size. You can see the second formula is based on the average headcount. Now, using the average headcount instead of just the opening headcount provides a more balanced view, especially in companies with fluctuating workforce sizes. Then comes the third formula, which includes the new joiners also. Now, this formula factors in new joiners, giving a more dynamic measure of workforce changes over time. Moving on to the next assumption, which is calculation of the leave utilization rate. Here we will be discussing the calculation of leave utilization. This is again an essential metric and helps organizations track how employees use their leave entitlements. Let's go step by step to understand the methodology. Now, the first step here is to gather comprehensive leave data to ensure accurate reconciliation from the beginning to the end of the period. The key components here are mentioned. Opening leave balance, which means the number of unused leaves carried forward from the previous period. Then your leave accruals, which means new leaves added to an employee's balance based on the company's policy. Then comes leaves availed, which means leaves that employees have actually used during the period. Then comes leaves encashed, which means leaves converted to cash, often due to company policy on unused leaves. Then leaves lapsed are the leaves that have expired and were not carried forward to the next year. And then the closing leave balance. Here, the final leave balance we have considered after accounting for all these adjustments. By ensuring all these elements are accounted for, we can move forward with calculation of excess leave utilization. Now we move on to step 2. Now, at the employee level, we need to determine cases where an employee's leave utilization exceeds their current year's accruals. This helps in workforce planning and policy adjustments. Formula are mentioned here for leaves availed. We have used a maximum formula where we are using max 0, leaves availed minus leave accrued. What happens is this ensures that only the excess leaves availed over the current accruals are considered. Similarly, we have used a formula for leave encashed. You can see on the screen. This formula also ensures that only encashments beyond current accruals are flagged. Now, by using these calculations, organizations can monitor whether employees are exceeding their leave entitlements and they can optimize their policies accordingly. Moving on to step 3 here. Once we have calculated the excess leaves at the employee level, we now aggregate this data at the company level to get a holistic view of the leaves utilization. For this, we compute total leaves availed, which are the sum of excess leaves availed across all employees, and total leaves encashed, which is the sum of excess leaves encashed across all the employees. Then the total opening leave balance. Here we have considered the opening leave balance for the employees present at the closing date only. Now, this aggregation helps in analyzing trends and making informed decisions about leave policies. Finally, we move on to our last step, where we compute the 2 key rates that summarize leave utilization at the organization level. You can see on the screen, average availment rate is calculated by considering total leaves availed, dividing that by total opening leave balance. And the average encashment rate is calculated as total leaves encashed divided by total opening leave balance. Now, these rates provide a quick snapshot of how employees are utilizing their leaves entitlement, whether they are using their leaves, they are encashing them, or just leaving them unused. Now, moving on, let's understand the reasonableness of all these actuarial assumptions used. Now, actuarial assumptions are a critical component in valuation and financial reporting. As per the accounting standard, these assumptions must be unbiased and mutually compatible to ensure accurate liability estimation. Now, let's assess the reasonableness of each of these key assumptions, starting with discount rate. Now, discount rate is derived using a mark-to-market approach, typically referencing high-quality corporate or the government bonds. Your discount rate must align with the currency and the term of the liability. In India, if you will see, the yield curve movement, monetary policies, and credit spreads typically influence the assumption. Hence, it is important to make regular updates. Then comes the salary growth rate. Now, salary growth rate should be based on your historical salary trends, your management expectations, and the projected inflation. industry specific salary hikes should also be considered. For example, in IT and financial services, their salary increments are quite higher as compared to the manufacturing sector. So we need to consider that. Then career progression and promotion cycles significantly impact this assumption too. Coming to the third assumption, which is the attrition rate. Now, attrition rate must reflect historical attrition patterns while incorporating future workforce. Sectors like IT and retail experiences high turnover, while core industries like oil and gas typically have lower attrition rate. Here, economic conditions, talent, demand, and industry stability are also key factors while evaluating this assumption. Coming to the last assumption, which is the mortality rate. Now, mortality rate is based on published mortality tables such as ILM 2012-2014, which is Indian Assured Lives Mortality Table. Especially in India, now longevity trends are evolving due to better healthcare. Hence, mortality rate also requires periodic reviews. Now, certain industries such as mining or manufacturing, like Ayush was also highlighting earlier, may have different mortality risks considerations due to occupational hazards. Now, by ensuring that these assumptions reflect market conditions, industry benchmark, and company specific factors, we can enhance the credibility and accuracy of actuarial valuations. For these assumptions to be reasonable, they need to be market driven, realistic, and aligned with each other. For instance, if salary growth rate assumptions are high, they should be supported by strong economic and inflation expectations. Similarly, a lower discount rate should correspond to a low risk bond yield environment. Attrition and mortality assumption must reflect industry specific realities to provide an accurate projection of the workforce trends. Any inconsistency among these factors can lead to misstatements in actuarial valuations. Now we move on to the recent market trends. Now you can see here we have shown the comparison of government bond yields between 31st March 24 and 31st March 2025. Let's break it down and try to understand this chart a little better. You'll see the blue line represent yields as of 31st March 2024, while the red line represents yields as of 31st March 2025. Now, across all the maturities, we observe a rise in yields, which reflect changing economic conditions and interest rate expectations. If you'll see, short-term bond yields have increased slightly, indicating short-term inflationary pressures or tightening monetary policies. But the most significant rise here is in the long-term bond yields, which is between 20 to 40 years, which suggests market expectation of higher long-term borrowing costs. This steepening of the yield curve is crucial for companies, especially while doing the actuarial valuations or ESOP valuations and while doing the financial planning, as it influences discount rates and long-term liability assessments. So, what does the trend mean for businesses and for financial professionals? So, here I have a few takes which I would like to discuss with you. First is the adjustment in the discount rate. With higher bond yields, company may need to revise their discount rates used in the actuarial valuations. Then the second take is on the impact on investments. Now, rising yields can influence your investment strategies, especially for the pension funds. And third is the cost of borrowing. Now, long-term borrowing cost may increase, impacting corporate financing decisions and expansion plans. Let's move on. Now, here we have done the analysis which examines the salary growth rate and discount rate assumptions used by the NSE 50 companies over the years. For financial year 23-24, the average salary growth rate stands at 7.7% per annum, reflecting wage inflation, industry trends, and economic conditions. Now, over the past year, we have seen fluctuations. If you see, there are peaks where salary growth, where it has reached 9% in financial year 2014, and a dip where 6.5% has reached in financial year 2021, which is likely influenced by macroeconomic factors such as economic slowdowns and pandemic related uncertainties. On the other hand, if you see the average discount rate, which impacts actuarial valuations, has gradually declined from earlier highs, reflecting movements in bond yields and interest rate trends. It dropped to roughly 6.5 to 6.6% in financial year 2021 before stabilizing. Now, a key observation here is that in recent years, the salary growth rate has overtaken the discount rate, which could have implications for long term liability valuations. Now, this trend reinforces the need for companies carefully evaluate their actuarial assumptions, ensure they remain aligned with economic conditions, market expectations, and sector specific realities. Let's move on. Now, this slide presents a sectorial view of salary growth rate assumption across the key industries. Let's take a closer look and understand this. The highest salary growth rate, if you will see, is observed in the pharmaceutical sector, which is 8.9%, likely due to strong industry performance and high demand for specialized talent. The automobile and metal sector also report high salary growth rate of 8.7% and 8.4% respectively, which reflects increasing labor cost and industry expansion. However, the industry sectors like IT and power, they show the lowest salary growth assumptions, which is 6.5%, possibly due to cost optimization measures and sectoral challenges. Other industries like financial services, you can see cement industry, then the services industry, their salary growth rate is in the range of 7 to 8%, indicating moderate salary growth expectation. Now, what does this data mean for businesses? First is the workforce planning. Sectors with higher salary growth may need strategic talent retention plans to manage costs and workforce stability. Second is the financial projections. Salary growth rates influence budgeting, cost projections, and actuarial valuations, which will impact your financial planning. And third is the industry competitiveness. Companies need to balance competitive compensation strategies with financial sustainability.